Hey traders, this is a video that's going to serve multiple purposes here. Usually every single end of month period we do a review of the results of the asymmetric trading system, but this particular video coincides with the end of last week's trading. It coincides with the end of March's trading, and it coincides with the end of the quarter's results. So we want to put all of that into this video here. And I also want to talk just a little bit in this video about where we're currently positioned going into April. So let's jump into that without any further ado. Just a quick review. January, we had a nice month, about a 4.84% return. We were positive alpha, meaning we beat the market with lower standard deviation, lower volatility, about 13 profitable days for every six losing days. So that was our ratio in January. Nice month of January. You can remember this. You can go back through this again with previous videos. But we had a pretty nice result for the month of January. Month of February was amazing. Very, very much probably an aberration in terms of what we can or even should expect. There's no real basis or thesis to really expect to make 8% a month, but that's very close to what we did in the month of February. 7.93% return. Again, we were positive alpha, meaning that we made more than the marketplace with a lower standard deviation, about 12 profitable days versus 8 losing days. Now, and there's the results of February. The month of March, guys, it was a very, very tough month. It was a frustrating month because it was a ton of give and take, give and take, give and take. $804 loss on the month on my $32,582 of starting capital. Now, as I've noted in a previous video, and I note here in our results, I did add $1,500 into my account here. So you'll see one day where the balance jumps $1,500. That's not factored into our returns. It's here. That's taken out of our results. But we did end up losing in my portfolio $804 for the month, a negative 2.46 return on the month. Now, we were positive alpha in that our standard deviation was substantially lower than the overall markets in March, meaning we had much less volatility, but we didn't beat on results. The market was up an astounding 4.24% for the month of March. And if you look at March, it seems like such a crazy number based on how much volatility we had, but we did have a lot of volatility. And that was the real key. We had 11 profitable days versus 12 losing days. And one of the things that you'll see here in the accounting is that about halfway through the month, I stopped tracking how many winners and losers we had every day, because I think we kind of now understand kind of how that works and how we take losses quickly and we let profits run, et cetera, et cetera. What I think is a more interesting metric is obviously where did we end up at the end of the day. And even on days, it's interesting in the month of January and February, as you go back and you look at those results, days where we only had one winner out of maybe 10 losers, we were profitable on the day. And one of the things that I think in going through and reviewing our results from March really hurt us was the whipsaws. Anytime we move our whole entire portfolio from a bullish stance to a bearish stance, or vice versa, there's some slippage, there's some costs involved in that, there's some spreads, and it's a sloppy process. And those particular days that we do that, and sometimes for the next subsequent 1 or 2 days after that, are almost always down days. They're almost always losses for us. And we had several of those whipsaws back and forth when in the month of March the market was sort of ebbing and flowing between buy and sell signals. One of the things that I think we stuck to our guns on and were fairly good with in March was sometimes just staying in cash. These days where we don't really have a bullish bias, we don't really have a bearish bias, the market is just sort of whipsawing back and forth. We stuck to our guns with a lot of cash in our positions, and so we were positive alpha. It's interesting, in March, one of the better standard deviations. We had some of the lowest volatility that we've had in the program, but if you're, 11 profitable days, 12 losing days, you're giving back every day what you're gaining. We didn't get anywhere. So it was a 2.4% loss on the month. There's the numbers, and you can look at them there again, and you can see that about halfway through the month, I stopped tracking our win-loss ratio because I think we get how that works now and the concept behind that. What I think is more interesting is where do we end up at the end of the day. And while we had some really good success with our rolls and our anchors, and we'll talk about that in just a minute, we had just a disproportionate amount of losing days in the month. You can see right here we had 1, 2, 3, 4 in a row. Had a nice day there, but then again 1, 2 more in a row. It's just a lot of give and take all month long that really didn't get us anywhere at the end of the month. So if we look at our overall results now for the program, from the start of the program until today, we can kind of see where we're at with the asymmetric system versus the S&P 500. In January, we made 4.84%, February 7.93%, March down 2.46%. That was that $804 loss for me. That's what that equated to, was a 2.46% loss on the month. If you add all those up, obviously, for the quarter, we are up in the program 10.31%. The S&P 500 had a little bit of a loss in January, 1.1% down on the month, up 2.64% in February, and just an absolute monster month. Obviously, if you annualize that out, 48, 50% annualized rate of return. Markets don't generally make 48 to 50% a year. With the volatility that the market had in March, it was a pretty darn good month. Pretty darn good month for the marketplace. 4.24% for the market, 5.74% overall gain for the marketplace. We are about double the market return. In spite of a bad month in March, we are about double the market return with about 45% of the volatility of the marketplace. So things are going well for us, even though March was a frustrating month. But I think that April looks a lot better for us here in terms of the trends that we're seeing in the marketplace. Let's jump in just quickly here and look at those trends. So as of the filming of this video, I'm filming this, actually it would be, I think, the second trading day of April. It's Monday, April the 5th, right before the market opens up. And we do look like we're having another big open here to the marketplace. You can see the markets are at all-time highs, and we've never been this high before. We've broken through the 4,000 mark in the marketplace. And we do have some open working positions inside of our account right now. So we talked a little bit about the whipsaws and how I think that's really hurt us in the month of March. I think we're really well positioned here going forward into the month of April, where we have a little bit clearer buy signal going on right now in the marketplace. It's a little bit more consistent, if you will, and we shouldn't be getting kicked out of things as much. We do have some open positions. I've still got an open Apple position, and if we look at Apple, you can see that it's very close to its 3% target of getting taken out at a profit. That is working well for us. We're leaving that. We've added some additional anchors to the program that, while they may hurt us on standard deviation, because we don't have that 1% automatic stop loss in there, we're going to get a little bit more volatility. We're going to get a little bit more fluctuations with these, but it should help us on the whipsaws a little bit. And one of them, of course, is our IWM. We use the Russell, and we use that in a bullish and a bearish nature. We are long the Russell right now, and that's in a profitable position. If we look at the Russell, we can see that it's moving in the right direction. It's in a bullish trend right now, and so we'll continue to hold the Russell here. And that's a very nimble position. We can switch that back and forth from bullish to bearish quite easily without too much of a disruption in our overall portfolio. We also added some more sort of correlated assets. We added the IWR, which is a REIT. It's a real estate investment trust. So it's, it's in the market, but it's not of the market. It is real estate based. We've got silver, which of course is a precious metal. And then we added the USO. All of these are considered now anchor positions. We don't have a stop loss on these. Again, it will allow a little bit more standard deviation, a little bit more fluctuation, but it should also allow a little less of the whipsawing effect to take place. And all of these are, as I have mentioned with our IWM, all of these positions are highly liquid. They are a little bit easier to be able to short on the downside. There are shorting alternatives to these. So let's just look at these real quickly. IYR, our real estate. Again, it does a couple things for us. It diversifies us a little bit more. Again, we're always trying to get an edge or an advantage over the marketplace, and we want to have alpha. And it's not always just about beating the market. It's about beating the market in a safer approach and getting a diversified leg of our overall portfolio in real estate is a good step in the right direction there. You can see that real estate's just been going crazy, obviously, through the whole pandemic period here. If we go back to the April-March period of last year, who would have thunk it that the real estate would have performed as it has, but it's performing remarkably well. Now, we try to create an edge, we try to create an advantage over just blindly buying the marketplace. One component that the IYR has, it does, because it's a real estate investment trust, it does pay a dividend. It has a dividend of over 2%. Last dividend paid out was on March 25th. So depending on where we are in our investing cycle, we very well could be short the IYR and not receive the dividend. We may not own it during the ex-dividend date when that dividend is going to be attributed to shareholders. But on the off chance that we are in that position, we now have a little bit extra profit driver for us in that dividend. And again, anything, guys, about 30% of the overall market performance, if you go back over 20 years, 25 years, about 30% of the overall market results comes from the dividend in the S&P 500. And so anything that we can do to add a little bit extra income to our portfolio, this will help us. This will help be accretive to what we're doing. It will help give us that edge or advantage. So the IWR serves a lot of purposes here. It's a little bit of a diversifier. It is has a dividend attached to it, and it is a little bit non-correlated to the overall market. So that's been performing well for us. We're continuing to hold the IYR position as it is in a bullish trend. Again, this is a position that's very easy to flip to the bearish side should we need to. Okay. Our SLV position, of course, this is precious metals. We prefer silver over gold, but those are obviously highly correlated. Silver hasn't kicked in for us yet. It's the drag right now that you can see on our portfolio. If we look at a chart of silver, you can see that there's our cost basis right there. You can see that it's starting to move in the right direction. All of the technical indicators look good for us. I was noticing on GLD, which of course again is gold and that's highly correlated, we had a hammer right there. It's a little bit hard to see on the chart, but that's a hammer. If we pull this down, let's go maybe to just a smaller clock. Right there, that's a hammer. And that's bullish. That's a bullish indicator. And of course, gold and silver fairly well correlated. And so I think that silver will continue to perform well for us going into the month. That is an anchor position. We're going to continue to hold that. Silver, once again, is a anchor or a core position that's very easy to flip from bullish to bearish should we need to. Okay, I'm going to skip the SPY for just a second here, and we'll look at our other core position, which is USO. That's oil. Again, we want to have something that is in the market, but not of the market, something that is not necessarily directly correlated with what the market is doing. and USO definitely meets that criteria. If we look at USO here, let's come back to a little bit longer term chart there. You can see that it is basically hovering right around our purchase price here. And if I go, let's go maybe out just a little bit here. We can see that we're starting to build a little bit of a support here, a little bit of a wedge that you can see that's a bullish wedge. Got some good news coming out of OPEC right now that they are going to be aggressive in trying to push prices higher. And so we'll see what that does here. But one of the things that's nice about USO, again, is that there is some alternatives that we can use. USO is and can be sometimes, as you see up here, hard to borrow. Doesn't mean that we can't short it. It's just a little bit more difficult to do. But we can short this. It is a bearish play as well as a bullish play should we need it. Okay. One other thing that I forgot to mention on the silver. So I am working with about a $33,000 portfolio. I mentioned that generally you want to have a minimum of $30,000, and I'm using about $33,000 in my portfolio here. And so these 126 shares of silver here are sort of the correct position size. I'm using about $3,000 a position because I'm using margin to do these trades. And so you see the margin requirement there, about $1,500. We're going to look at starting some opportunities here maybe in this month of April to look at doing the same thing with our silver position as we have been doing with our SPY position, which is cash flowing it, generating covered calls off of it and using that income to supplement our growth as well. So we'll be talking about that a little bit more going forward here as we go forward. Now, our SPY trade. Oh my goodness, let's talk about this. So again, I cannot emphasize this enough that our mandate or our goal here with our asymmetric profile or excuse me, our portfolio is twofold. Yeah, we want to beat the market. That's a clear goal. We want to have some returns to speak of, and we want to do better than the overall market. But we want to do it with lower risk. We want to do it with lower standard deviation. And this SPY trade, guys, it couldn't be any better for us right now. It simply could not be any better for us. And what I mean by that is we have this long-term leap option, which is nicely profitable for us. In my case, again, we want to do one contract per roughly $35,000 of account value. So I have an account that's between $30,000 and $35,000. So I'm using one contract. And on that one contract, it was about an $8,000 investment to purchase that leap option. Well, we're up nicely on that. We're up about $900 on that. And we are continuing now to cash flow this with a short-term in the money call. Now, this is the best of all worlds. This gives us exactly what we're looking for in this program, in that it gives us the ability now on a weekly basis to make money with our SPY position. If the market goes up, we're going to make money if the market stays the same, and we're going to make money if the market even goes down. Now, the last time I checked, that's the only three things that the market can do. It can go up, down, or stay the same. We're in a position right now to make money in all three directions. And we will make money in this not only if the market goes down, but if it goes down to this 389 level. So we've got a lot of downside protection, a lot of support in this marketplace. How is that happening? Well, you can see right here, these two positions are offsetting positions, right? So as one, because it's a covered position and it's in the money, whatever we're making now in our long-term leap option, the call that we own, whatever we're making here, we lose here, and vice versa. It's just a give and a take, right? So where is the money being made? Well, the money is being made by reselling these covered positions over and over again. Now, premiums change and they're going to ebb and flow and they're going to adjust over time, but I want to look at just rolling this out now for a couple of weeks. Let's look at this option right here, about 97 cents. That's probably pretty ballparkish of where we would be. You could see, again, this is about 2 weeks out, about 2 weeks out, and we would be bringing in about $100. So I just want to use that number as a ballpark to sort of look at this, okay? $200 a month, $2,400 a year is the income stream that I'm bringing in off of an $8,000 investment. Now, that's a 30% implied rate of return potential there. I've got 30% cash flow coming off of one of our core or anchor positions, and that position is a very small component of my overall portfolio, but it goes immensely towards our overall result. So on $8,000 of my $35,000 portfolio, I'm cash flowing about 30% a year. Guys, that's where the edge, that's where the advantage that we are searching for comes in this portfolio. Remember, again, the mandate is not just to beat the market, it's to do it in a much safer mode. And the position that we're in right now, where the market can go up and we make money, the market can go sideways and we make money, the market can go down and we make money, guys, that's ideal. That's absolutely ideal. So for right now, until the market gives us a signal switch from bullish, which is where we're certainly at right now in the marketplace, to bearish, we're going to stick with this. We're going to continue to roll it. We're going to continue to try to bring in that income every single month, month after month, and just use that to build our not only cash flow, but our safety net. So that's an overview, folks, for where we're at for the month of March. It's where we're at versus the marketplace for the first quarter of the year, and a little bit of a preview of where we're going into the month of April. We are still working on a couple of other tweaks, folks, that are, again, going to give us a little bit more stability, a little bit more of an edge, and a little bit more cash flow. So those will be rolling out here over the next subsequent weeks. Have a great trading day, guys, and we will talk to you once again at the end of April.